Well, last week saw significant turbulence in Wall Street, triggered by a crypto crash that unsettled broader risk assets. As Bitcoin plunged, market makers faced additional pressure in an already fragile trading environment. From stocks to gold to oil, almost every asset class ended the week deep in the red. In geopolitics, traders also assess the prospect of a Russia-Ukraine peace deal. Reports are emerging that the US has threatened to stop supporting Kiev until it agrees to a pact that favors Moscow. While in global markets, it was a sea of red last week, worsening a slump in cryptos. The digital assets engine is sputtering, with Bitcoin and its peers enduring a violent unwinding that has shattered confidence. Over $1.3 trillion has been wiped out of the crypto markets. Bitcoin was the biggest loser, crashing over 12% last week to trade around $84,000, which is a 7-month low. Despite the risk-off bets, gold also ended in the red, but closed above the $4,000 an ounce mark. Oil prices fell, with benchmark Brent crude falling 3.7% to end the week below $62 per barrel. The dollar has gained significantly over most of its peers. Still, differing bets on the Fed rate path have moved the dollar's needle between gains and losses. Now, shifting focus to the Asia-Pacific stock markets, the rout in global tech stocks weighed on regional stocks. The Chinese benchmark in the Japanese Nikkei crashed over 3.5% during a volatile week. Weak economic data prints through the week, suggesting any upside is limited in the coming week. The Aussie index closed 2.5% lower, defying a broader sell-off in global markets. Bets for Indian stocks to hit fresh record highs are once again on the horizon. The Sensex ended the week nearly 1% higher. Now in the Americas, the S&P 500 crossed 1.9% lower. The tech-heavy Nasdaq 100 sank nearly 5% from its intraday peak, its sharpest reversal since April. Nvidia at 1 point shed nearly $400 billion despite beating earnings expectations. The AI darling stock is heading for its steepest monthly decline since March. The Goldman Sachs index of retail favored stocks has fallen 17% from its October high. The story for other stock markets in the region was no different than this. While across the Atlantic, all European benchmarks closed out last week deep in the green. The German DAX was the biggest loser, with a 3.3% fall from the economic troubles in Europe's growth engine. The French CAC fell 2.3% and the UK's FTSE index closed 1.6% in the red ahead of the budget. The South African index fell 2.1%. Now, having looked at market moves, let's now turn to the overall economic outlook. In Asia, Chinese data shows momentum fading into the final stretch of the year. China's key activity indicators continue to slow across the board in October as policymakers appear to be delaying further policy support. Instead, China's central bank is likely to conserve ammunition for next year, depending on how the trade scenario with the US plays out. Trump's trade rhetoric continues to weigh on the outlook for most of the other regional countries, despite recent deals that have been announced. But India still remains the bright spot, with momentum indicators pointing to a healthy speed of growth. More positive numbers are expected from a trade deal with the US, which President Trump said is almost done. Now in the Americas, the buzzword is uncertainty. The US said the jobs data will be released only 10 days after the Fed meeting. Expectations are for a deep divide within the Fed, with bets swinging between a cut and no change next month. The central bank is worried about driving in the fog from the lack of data. Now elsewhere, the outlook for Canada, Brazil and Argentina is still negative because of Trump's brinksmanship. In Europe, Florence or Frankfurt, every place in the region is seeking to push through the much-needed reforms. Europe's growth engine, Germany, is still stuck in stagnation. Finally, the German government has agreed on several measures that at least show a willingness to act, even if a bigger master plan is still lacking. UK continues to struggle to fill a budget black hole. The size of most economies in Europe are still well below their pre-COVID levels. European countries quickly need a clear long-term strategy and less wishful thinking with full pockets.